Okay, good morning. And this is our last class. So today the plan is first, we will go over the slides of chapter 23, because last time we didn't really, we more just kind of summarize what's in that with some examples. So we'll go over it quickly. And then we will talk about the final exam, which is scheduled on the 14th, and we'll do some exercise. Okay. So yeah, last time we kind of discussed the some additional measurement and disclosure issues by asking questions, like and as I said, that this is the chapter for us. We just introduced the issues. I summarized the discussion into very few slides, just introduce create this awareness. And if we're going to deal with such related issues in the future, you know where to go to look for reference, to get more information. Okay, so the first thing we talk about is the idea of full disclosure, which I believe was first introduced in 3350. So the idea is that a reporting entity should report any information that's relevant to decision making, and to include information relevant to this. There are ways to communicate that information. Of course, financial statements and the notes are, the core part of the financial reporting, and which is governed by, the GAAP being at first, or ASPE. But there are other, like even in the annual report, we have MD&A, which is usually half of the annual report, which is not audited, right? But there's lots of information in the specifically the information that's not included in the financial statement. We include discussion of various risks and forward-looking information. These are usually you do not find in the financial statements and footnote. And then there are even other, like if something come up, it's really important, a company should talk, have a conference call, make sure the information is available to the public, so on and so forth. There's one interesting discussion about this is sometimes there is bad news and the company really does not want to draw attention to it, but they know that they have to disclose that. So they tend to disclose it in such a way that does not draw attention, bury a bunch of the mundane, unimportant information. You guys heard a story about Enron, which was really was like a very American success company, but turned out it was like built up on lots of lies. And after Enron went bankrupt, like people just go back to say, how could it be this going on for so long and no one knows? Obviously, they lied outright with the in cahoot with the auditors, but they also engage in, like, among many techniques. One is they use the language just so convoluted and so complicated, like the long sentences, the whole paragraph is one sentence. You read every word of it, you know every word, but you really do not know what they're saying. They're not trying to be clear. They're trying to be vague, intentionally vague. So they were saying, like, by hiding, like, kind of obscure the information is not full disclosure either, even though it's there, it's buried in the fine print, but that's not in the spirit of full disclosure. Accounting errors and illegal acts. So because the financial accounting standard have built-in flexibilities and discretions, so sometimes, and then it requires judgment, human involved. So sometimes it's an honest mistake, and that would be considered accounting errors. There are unintentional mistakes, but sometimes that's the intentional bias, that's irregularities, that they are intentional distortions of the statements. There's a difference. Okay, so either one is not good. Either one will reduce the quality of financial reporting. So here is how the responsibility is shared. So the company management is responsible for ensuring operations are conducted within the applicable laws and regulations that determine the amounts to be reported in the statements. In other words, companies are responsible for financial reporting. Auditors are responsible to help company to identify non-compliance within the applicable laws and regulation that could have a material effect on the statement. So auditors check on that and verify that, lend credibility to the financial reporting. So these non-compliance include both accounting errors and irregularities. So that's it. Segmented reporting we mentioned. So consolidated statements combine everything together. However, much information is hidden in the aggregated figures, right? To kind of offset that, to counter that, segmented information is required. Segmented reporting provides information about the different types of business activities and different economic environment a company operates in. So the segments can be product line. So that, for instance, some company have retail and finance services. So there are two different type of business activities. More recently, a lot of retailers have in-store sales, but also increasing activity in online sales. So that can be different segment. A different economic environment, geographic location usually is disclosed. If you have international versus North America, you have Canada, you have US, and you have South America, you have Europe, because they're dealing with different factors in the business environment, and usually they grow at different rates, so that make it important to know. The segment reports should review like revenues, profits, assets, liabilities of each segment. So with such separated information for different segments, hopefully that will help the readers to understand the business better. Okay, a lot of talk about what constitutes a segment. How do you define a segment? Because this is a balance between providing useful information to the users, but a company are reluctant to do that. They don't want to reveal too much of their secrets to their competitors. If you look at this is a few years back. I think probably is different now. This is when I was a student. We look at GE's annual report. At that time, GE, yeah, their light bulbs were a lot more expensive than the other brand of light bulbs. And this is a long time ago. Their light bulbs has better quality. And when they're new, they're the same. But the other brands, the light become dim after a little while, and theirs stays bright. And so their price is a lot higher, but they do not want to know. they do not want the competitor or the public to know the markup of their products. So they would make their segment, they combine with something else. So you cannot pass up, because I suspect that the markup will be very, very high. Right. So in response to that, to companies' effort to not review too much, there is very strict guidance in what kind of segment. You can't just call anything segment, right? The segment used for financial reporting should be the same segment you organize your business. And they call it the operating segment. And for a operating segment to be qualified as a reportable segment, it has to be big enough. Essentially, it has to be big enough. So in a typical rule of thumb will be 10% of revenue, 10% of assets, or 10% of profit. Okay, and too much information is not good. So the segments should not be more than 10. So that's the rule of thumb. So make it useful, meaningful, but without too oversupply of information. And the other thing you will find in financial statements is the interim reporting. So that's in North America, basically we're talking about the quarterly reporting, right? So it's less than 1 year. And then there are a lot of issues in terms of how to allocate the annual expense into different periods. Like more difficult one is income tax, because if you look at a quarter, the earnings usually is lower, but with the progressive tax brackets, your actual tax rate based on annual earning will be a lot higher than if you just look at the quarter earnings, those kind of the issues, right? But the objective is to provide more timely information. It's controversial, as I mentioned last time, that provide timely information, but without emphasizing so short-term performance. It's kind of the two sides of that. For interim reporting, you will have a full set of financial statement, but you try to follow the annual reporting rule as much as possible, but there are differences in certain areas. Subsequent event we talked about, that's the event that occurred after statement of financial position date. No, that's the beginning of this period. This is the statement of financial position date, and before the date of financial statements authorized for issue complete. So usually it takes about like if we have to, because when you do research, right, you could think, oh, if the information come out, what's the results? But you can't use December 31st because December 31st is the end of the accounting period. Information is not out yet. If we have to choose a date, usually it's March 15th. Some companies a little early, some companies a bit later. They choose March 3rd. That must be that company's a little bit early. So that takes about that's 2.5 months, right, to get all that done and get it audited and ready to publish. So a lot of things could happen in 2.5 months, and that's the subsequent event period. Things happen. If that's something, the event is about the condition already existed and a statement of financial position date, then you have to recognize, means you have to make adjustment to include it in the financial statement. But if it's about something new condition, you only disclose it if it's material. The last issue is related party transactions. So we, when we recognize the transactions, there's a arm's length assumption, right? So everybody gets a fair price. Basically, nobody is coerced, nobody gets a favor. So that's the unrelated party. But when there are transactions between related party, the price may not be the fair price. That's a concern. Tesla is being sued as we speak for their purchase of a Solar City. So Solar City was Elon Musk's cousin's company, and they were related, but I think Solar City was struggling, and I don't know the ins and outs, but I do read that Elon Musk and cousins, they were all really smart and ambitious people, and they usually have these powwow sessions, talk about business ideas. And Tesla's like, I am really busy with, Elon Musk was busy with all my projects. But if you guys are looking for projects, like I'm going to need these batteries and the alternative source of energy, solar panel is a good thing. So at one time, so Solar City was the largest solar panel installation company in the US, but they were struggling. So Elon Musk, I don't know, but since he controls the Tesla, so Tesla bought Solar City. But some of the Tesla shareholders are not happy because they think Tesla paid way too much to buy a struggling company that's owned by his cousins, right? So because that's a related party transaction, and the SEC will look into it to see if the price is fair, So the rules about the related party transaction and the SB and the IFRS is different. SB says we will not use the actual transaction price if it's not a fair price. Instead, we'll make adjustment. So like to reflect the fair price. But IFRS does not require adjustments, instead just disclosure. Okay, so that summed up this chapter. So these are the issues we talked about: full disclosure, accounting errors, illegal acts, non-compliance, segmented reporting, interim reporting, subsequent events, and the related party transactions. The final exam, so now we're done with that. Final exam will cover the chapters after midterm only. So we had midterm based on the first three chapters, and we also had a post-midterm bonus quiz. So I think that's coverage of that 3 chapters sufficient. There's not going to be any question directly related to that first 3 chapters. Indirectly, sometimes, like maybe, I'm not intentionally looking for questions from those 3 chapters, but if like, when you talk about the cash flow, you talk about various transactions, if it's related to income tax. So deferred tax is not cash tax, right? So that kind of can relate back to the chapter 18, talk about income tax, but that's indirectly. So the weight distribution is, I have, unlike first midterm, this time I have some true, false, and multiple choice questions, just cover up various like small points, right? But I have one problem for pension problem. That's a 10%. And I have 2 problems for leases. That's like 30%. Because there's lots of material. We have IFRS, we have SB, we have leases accounting, we have lessors accounting, and there are lots of details, right? So that's 2 problems, 30%, and the statement of cash flow, also 2 problems and 30%. So one of the statement of cash flow questions would be the basic statement of cash flow. And the second one will deal with some of the items that would be in the domain of complex in cash flow, such as, gain and loss from selling equipment, such as fair value for net income investment. Yeah, we will not deal with this complex issues that we did not have example, like such as bad debt allowance for doubtful account. That creates problem too, but we did not have example cover that, so we will not cover that. And then, so that's a 70 points and a 30% true, false, and multiple choice questions that would include the concepts and the issues of the first two. There's nothing to share. I'm just talking. Yeah, and there I don't have document to share. True, false, and the multiple choice questions, 30%. They include chapter 23, as well as for the chapter 19, 20, and 22. Okay, chapter 23 should not have more than 10%. Any questions about that? Now we have the format of the exam should be familiar to us because all our quizzes are multiple choice questions. Most of the quizzes are multiple choice questions, true, false questions, right? And our midterm would be the written response type of questions. Okay, so let me see. Yeah, there's nothing on the screen. Sorry, I'm just summarize the exam. But I do have a few more questions to, just for us to do in the class, like what we did last time. We did questions about chapter 23, but I have some questions like, these are only true, false questions because we had also multiple choice questions in the quizzes, but not as many true, false questions. So these are true, false questions I have. Okay, so yes, I better turn it off here because sorry. Otherwise, you can see as people send in answers who choose what answers, so kind of you'll be influenced. These are just exercise. These are not a quiz, so you will not get bad marks. You won't get any marks, to be honest. Did you guys get in yet? Yeah. Okay. You guys all got in? Oh, okay. Oh, that's the reason I did not get the email updates over the weekend. And I was like, this is unusual, but it's very relaxing. I got, oh, we're caught up. And then Monday morning, the secretary called. It's like, the chair is waiting for you to reply. Okay, so and let me count 3 in case someone wants. 1, 2, 3. Okay, so this is our answer. 2/3 of us is true. 1/3 of us is false. The correct answer is true. Okay. Well, the pension accounting is basically off balance sheet reporting to the great extent. We have assets and liability, neither one are on the balance sheet, but we do have these continuity schedule to keep track how they changed, what changed by what amount. And for assets, the contribution you made to that will be added to the plan assets, and the assets itself is invested. So the return, the actual return will be added to the assets, and then any benefit distributed will be deducted from that. Okay, so yes, the actual return on plan assets is added to plan assets in the continuity schedule. So that is true. Now, a third of asset falls. I won't ask you now, but I will ask you in a minute why you choose false. I kind of have an inclination of that. So the second one. Okay, I'll count 3. 1, 2, 3. Okay, so 77% to say false and 23% to say true. Now, anyone who picked the false want to elaborate? Online, you can say speak to. Is the return included in the expense at all? Did you think so? Did you not think? You didn't think so. See, that's that. Okay, so the same thing we're talking about for the actual return on plan assets. Is it included in expense or not? If it's included in expense, it should reduce expense, right? Because like plan asset increase, you have more resource to cover the liability. That should reduce the cost for the company to incur, right? So this is two things we need to ask. One is which set of accounting standard we're talking about. So I'm glad this is not an exam question because I meant to put under if first. If it's under if first, this will be false because under if first, only expected return is subtracted to determine pension expense. Expected return. It's the plan assets times that discount rate, right? So any difference between actual return and expected return is called the remeasurement gain and losses, goes into other comprehensive income. Remember, right? So under if first, expected return is subtracted to determine pension expense, and the difference between the actual and the expected return is the remeasurement gain losses that's included in other comprehensive income. The objective of doing that is to mitigate the volatility in earnings, because if you have a fairly big pension assets, if you have a good year, you will have a high return that could be a big number, and would change your pension expense too much to result in a volatile earnings. And if you have a bad year, you have a loss, right? So expected return is basically long-term average return. Okay, so that you average that volatility out. Under ASPE, there's no such a thing as other comprehensive income. Then the whole thing is included in earnings. So you could be right if you choose true, if your argument is that under ASPE, that is true. But you could be right if you choose false, if you sit under IFRS, it's false. I don't know what your reason, but reason is important. Reason is important, right? So that's about that. Now, I noticed there are a couple of questions about the course, so I'm just going to respond to that. Is there a quiz coming up? There's not quiz coming up. Okay, you done your last assignment, and for that matter, the written questions. How many written questions? 5 altogether. 5 written questions. Yes, Mary, that's correct. 2 on the statement of cash flow, 2 on leases, 1 on pension. Thank you. These questions are very similar in format to the assignments, and review the assignments, like the detailed solution to the assignments are provided. That really you should review that, you know, because both the contents and the format will be very similar to the final exam. So, so that's about that. Okay, I have a few more. This one we just talked about subsequent events. I'll count 3. 1, 2, 3. 81% says true, and it's wrong. 19% is false. It's correct. The answer. Okay. So we just mentioned that quickly. So all significant subsequent events should be recognized. The key word is recognized. In accounting, recognize have very specific meanings, right? Recognize is not reported, right? You can report it without recognizing it, because recognizing it means you have to prepare an entry. It will be part of the financial statements. You can report it by disclosing it, right? So, as we said, there are 2 types of subsequent events, like only the ones that give you information about existing condition will be recognized, right? So if you are being sued and the lawsuit was pending at the end of fiscal year on the statement of financial position date, and then you estimated certain way, but later on, before the financial statement was complete, the case settled. You know, you didn't think you were going to have to pay any compensation, but turned out the court disagreed, saying, well, you have to pay. Now you have to readjust that, right? But if you're fine, there's no lawsuit at the end of fiscal year, but after the fiscal year, you're being sued. That's a new case. It was not filed yet on statement of financial position date, but it's being filed now. Somebody sue you for $1 million. Regardless how likely you will have to pay, you disclose it, because this is not something happened in the previous year. This is something happened after the year is over. Whereas that on the lawsuit that was pending, that was something already happened before the fiscal year end. You just do not have all the information to estimate accurately. And after the year is over, you learn more and you can estimate it more accurately now. Then you need to use that information to estimate. Does that make sense? So only the subsequent event give you information about conditions that's already existed on statement of financial position date will be recognized. The subsequent event about the new condition will be disclosed if it's material. Okay, so reckoning, there is like, this is last of our courses, so there are things that comes up. I think I would like to cover. One is like the difference between recognition and disclosure, right? So these are two different ways to report. And another one is often comes up. Do we know the difference between expense and cost? In everyday language, we do not distinguish it. Sometimes they are used interchangeably, like a living expense, living cost, pretty much the same thing. But in accounting, expense and the cost are very different. Expense is the items you recognize in the income statement. A lot of costs are not recognized in the income statement. They are not recognized at the same time, right? So for instance, when you purchase a PPE, there's a cost incurred to buy it. But that amount only expensed gradually when you depreciate. So they're not the same thing. In fact, that if you mix these two up, that will represent a serious, what you call it, what's the word we just said? Not accounting error one. Irregularity, is that what it said? Yeah, that one. Because if it's a cost, it's an expense, you recognize it only as a cost but not an expense, you will overstate your earning. There are a lot of lawsuits based on this misclassification between expense and cost. One of that is a Canadian case. I don't know, you guys know there, Garth Drabinsky, and he was a producer. He's a producer. He produced a lot of hit shows like Phantom of Opera, we have it in Canada, but Broadway too, Showboat, and there are lots of them. And I won't go into detail. The show business is very different. And he didn't understand it. The show business is like, you do not want to incorporate it. You want each show to be separate, because you could have 10 shows, only one make lots of money, right? And if you want to set up a business like to be the behind all shows, then you will never make money, because whatever money made in that one show will be sucked drained from the other shows. So usually what you do is you each one, if it didn't show, each one is separate, but he didn't understand that. And he had some success and he decided to just do that. But in the end, his company is in trouble. So what he did is he would capitalize lots of actual expense, like a hotel, like a travel, like a entertainment, like basically the food they eat, the wine they drank with the clients, right? So that he capitalized this, the amount expensed, the amount spent as asset. So that's when you have a cost and you did not expense it. Instead of the proper way is this money spent, there's no future benefit, right? In order to capitalize, you're saying there is future benefit. He didn't do that. So that was the fraud, accounting fraud he was prosecuted for. And he was convicted in US, but he fled to Canada. So that's the thing. So it's a difference. And another thing, if I have time, I will talk about, is the reversing entry. You heard that a lot. What is that all about? It, you know, like I would like to dispel lots of these ambiguities. Like I kind of heard about it, not exactly sure. So let's just talk vague because, you know, I want to dispel some of those things. So let's continue with this first, and then if I have time, we'll get to that. So the key thing here is the recognition, recognized. Okay. Next one. Where is that? Oh, here. Some questions about lease.
I think it disappeared. Yeah.
Ah. Oh, okay. I don't know what to. I will skip that one because it seems like one. Let me see if I can relaunch it afterwards. I'll see. If not, I'll just talk about it. I didn't touch anything. It was just. I'll count 3. 1, 2, 3. Okay. So a leasee should always use the lesser rate if it is known under ASPE. And 36% of us is true, 64% is false, and the false is the correct answer. So if leasee does not know lesser rate, there is no choice, no decision to be made, right? You only have one rate, leasee's incremental borrowing rate. But if leasee knows lesser rate, under ASPE, it's a lower of 2. Yeah, but under IFRS, it's always lesser rate. So here's the IFRS and the ASPE is different here. So the lease chapter has lots of details. And so that's one. The next one is also about the lease. Residual value. I never have a question. Everybody agreed. Lesser. Okay, let me count 3. 1, 2, 3. So let me ask you, if you can you change your vote?
No.
No, you can't. Yeah, I think I should remind you to think carefully before you vote. So this is lesser should include a residual value in setting lease rental payment only if the residual value is guaranteed. The answer is false. Leasing only include the residual value if the residual value is guaranteed. That would be correct for leasing. When leasing calculate the lease liability and lease assets, only if the residual value is guaranteed, it will include the present value of the residual value, right? Lesser, on the other hand, would include residual value regardless it's guaranteed or not in setting the rent. So that's as I said, this chapter has lots of these details. Yeah, but I suspect that some of you at least choose the true answer, remembering what leasing has to do, right? Yeah, so yeah, read carefully before we go. Let me see if I could go back to the lease one. Okay, this is the one. This is the one that disappeared on you. Now I'll give you another chance. Then count 3. 1, 2, 3. Was it for a while? It's all true, and then some people decided to do the same. Other things being equal, an entity will recognize more lease assets and liabilities under IFRS than ASPE. It is a true statement, right? The difference between IFRS 16 and ASPE is IFRS uses a contract approach, that if a contract conveys the right of use property to another party for consideration, then we say that contract is lease contract. And all lease contract, except only the short-term or low-value lease, will be capitalized. So almost all the leases that would be considered operating leases under ASPE would be considered right of use lease under IFRS, right? ASPE uses classification approach, classify leases into finance leases and operating leases. And finance leases will be the leases very similar to installment purchase. 75% of useful life, 90% or more of the fair value. So a lot of leases will be considered operating lease under ASPE, but would be right of use lease under IFRS capitalized. Remember, I showed you Dollarama's balance sheet, and after IFRS was introduced, that the assets increased by 50% and liability doubled because all their lease for their store places before would be off balance sheet and the IFRS 16 are on balance sheet. So that's actually one of the most significant impact of IFRS 16s. Okay. Oh, okay. I'll count 3. 1, 2, 3. Lease liabilities are non-current liabilities. It's not entirely correct. This is actually current portion of a long-term debt is current liability, right? So current portion of lease liability are current liability. And as lease, we all know you always have like regular lease payments, right? There is always a current portion, like next lease payments, always part of that is paying for the lease liability. Part of that is interest. Does it make sense? Yeah. So if you imagine that lease amortization table, the liability balance reduces with each payment, and that payment, that the reduction at the end of the year would be current portion of lease liability. And if you look at the balance sheet, they also have current portion of lease liability and the non-current portion of lease liability. Exactly same as debt. Current portion of long-term debt is current liability, and the non-current portion is not non-current liability. Oh, sorry, I did not share. This is 60% of us is false. Correct. 40% is true, incorrect. On count 3. 1, 2, 3. We're quite even. 55% is false, 45% is true. Leases rental payment for capitalize the leases is partly operating cash flow and partly financing cash flow. Now this I would very much to know why you choose false, why you choose true. What did you choose?
But it was either either or. It's either operating or financing, not both at the same time.
The interest part.
Yeah.
Yeah.
That's what I thought.
Yes. Oh, no. That's what you said is only true for the interest part.
Okay.
Yeah, for the interest part. So you choose false.
I did choose false.
You did choose false. Yeah. Anybody choose true here? What did you?
Well, I thought it's similar to him that it's either or, but I was thinking that there was probably two parts of the interest and the actual payments, so we break that up. Probably one, what's the other?
Yes.
That's why it was true.
Right, because the payment is always part interest, part principal, and the principal part is always financing. The interest part, now you could be right choosing either one, depend on how you argue it, right? The interest part under SB, it's always operating. And the IFRS could be operating, but you could also count that as financing as well. So if you choose if you choose true, thinking either SB or the interest payment is considered operating cash flow, you are correct. But if you choose false to say under IFRS, interest can also be financing, then you could be correct. So that's why this is good poll question, but not good exam question. Because if I use this as exam question, I have to give you credit regardless what you answered. Even though your thinking is not correct, I still have to give you credit, right? But it's very good poll questions, give you a chance to discuss that, right? This is all behind the reasoning, because there are many issues here. First of all, we did not mention IFRS or SB. IFRS and SB treats interest differently. And the SB interest payment is always operating cash flow, and the IFRS, it can be operating, can be financing. So that's one thing. And secondly, knowing that lease rental payment is always almost part interest, part principal, right? So there's two things. Does it make sense? Okay. All right. Oh, okay. I think now I learned how to relaunch it. Here. I'll count 3. 1, 2, 3. Okay, so the question is cash paid to purchase fair value through net income investment is an investing cash outflow. 65% of us think it's true and 35% think it's false. it's false. It's false. And I put it in a question knowing that this investment, the word investment, would have persuasion power, right? You call it investment. But remember in the very last example we did, like in that cash paid, cash received, selling it, it's all in the operating cash flow, because this is the argument that fair value through net income investment is managed actively with the intention to buy and sell at the right time to profit that way, right? So from that perspective, it's similar to inventory. You buy and sell inventory to profit. And here you buy and sell net income, fair value net income investment to profit. Okay, for that reason, that cash paid to purchase it is considered cash, operating cash outflow, and cash received from selling it is considered operating inflow. And also we remove both unrealized gain or loss and the realized gain or loss from net income, because those are not cash amount. Cash amount is cash received to sell it. Right? Yes, it's in the last example we did. Okay, so this is one of these complex issues related to cash flow. I don't know why that happens, but I have a good fix now, so it doesn't. Oh, count 3. 1, 2, 3. So typically, cash from operating activities is greater than net income. When you make adjustment using, when you prepare statement of cash flow, use indirect methods, you kind of reconcile from, you start with net income and end up with cash flow, right? So 59% of us are correct. This is a true statement. 41% it's false. It's incorrect. Why? Why typically cash from operating activity is greater than net income? Well, when we prepare statement of cash flow using the indirect method, we start with the net income and we make adjustments. All the adjustments we make can be classified into 3 categories, right? Change in working capital, like accounts receivable, accounts payable, inventory, accrued liability, and so on and so forth. That increase in assets is subtracted, increase in liability is added. So if the company grows, both working capital assets and the working capital and liability will increase. But since the increase in assets subtracted, the increase in liability is added, they offset each other. Okay, so it's usually like some years positive, some years negative, but because they offset in each other to some extent, so usually there's no one way or the other. Also, the amount is not great. right? Because it's the net. The second category of adjustment will be gain or loss from transactions that's not operating, that early retirement of debt, sell PPEs, investing or financing. Now, because again, that there's no reason that you always sell your things at a gain or always at the loss, so that it's not only always one direction and the gain loss offset each other. So usually the impact is not in one direction, and usually because it's net, right? Gain will be subtracted, loss will be added. The third category is non-cash expenses, depreciation, amortization, the impairment loss and things like that. All those will result because non-cash expense, so they are subtracted from net income. The adjustment always to add them back. So adjustment is always positive and often significant, because depreciation expense for lots of companies is a large expense. So that, like, consider the other two categories, it's not significant one way or the other. This third category is always positive and often significant. So it's typically CFO is greater than the net income. So that's, well, I think that's last of these questions. So these are two purposes. One, review of some of these details, and the two, these will be the type of questions that will be in that 30%. There are multiple choice questions like a quiz, and there are true false questions like these. Okay, now I didn't mention about the reversing entry. However, I have about the 6 minutes left, so it's not enough time. So what I will do, I have a good example to explain that. If you are curious, you want to know, I'll post it on the Bright Space. Okay, so for your reference, so you can get the bottom of that once for all. Okay, so we have 5 minutes left, so I will just end here. There's quite a long our exam. What day is this? The 14th. A week from today. Okay, so is that your first exam? Do you have any other? It's a first exam. Okay, okay. Review the assignments, review the quizzes. I will make them all available for you to review. And if you have any questions, feel free to approach me. I just changed the password, so it's not going to be a problem for the next 7 days. And if you want, feel free to request a Zoom office hours. I will be happy to do that. Other than that, thank you very much for showing up. It's nice to talk to some live person, and good luck. Okay, bye-bye.
You know what time the exam's at?
It's 9:00.